Hello, everyone. Good afternoon. Thank you all very much for attending the Koppelman School of Business Dean's Leadership Speaker Series today. I am Dr. Ching Hu, Dean of the Koppelman School of Business. As the premier public business school in Brooklyn and one of the best business schools in the New York City, Koppelman is committed to serving our diverse students and the local and global communities with its transformative, high quality, and affordable business education, as well as high impact and applied business research by our world-class faculty, faculty associates, scholars, experts, and executives from all over the world. Today, I am delighted to announce the commencement of the Koppelman School of Business Dean's Leadership Speaker Series. This series will invite prominent business executives, community leaders, and successful entrepreneurs from all over the world to discuss social, economic, cultural, political, and leadership topics that have very significant impact on our society and local and global economic development. It will offer extremely valuable opportunity for our students, faculty, and community members to have direct dialogues with those world-class business leaders, scholars, and experts on a variety of topics. We're very fortunate today to have a prominent Wall Street executive and world-leading economist, Joseph Cohen of Goldman Sachs, as our distinguished guest speaker. I am sure most, if not all, of the audience today know about Abby and her extraordinary career on Wall Street. I am extremely grateful that Abby agrees to be our inaugural speaker of the Koppelman School of Business Dean's Leadership Series. I asked Dr. Mary Ockham, moderator of today's event, to formally introduce Abby in just a few minutes. Dr. Ockham is a professor of economics and the interim associate dean of the Koppelman School of Business. Her specializations are in global economics and applied international macroeconomics and finance. She has served as the executive officer of the PhD program at the Graduate Center of CUNY. Currently, she serves on the advisory board of the Ways and Means Committee of the New York State Assembly. She came to Brooklyn College from the Federal Reserve Bank of New York, where she worked as an economist. I now turn the Zoom to Dean Mary Ockham, who will introduce our guest speaker and moderate the Q&A session. Thank you all very much for attending this event. I hope you will find the time well spent today, and I'm looking forward to seeing you again at our future events. Mary, please take it over.
Thank you, Dean Hu, for your introduction. It is my great pleasure welcoming you all to today's talk. As you all know, over the last year, as a result of the pandemic, the world economies went into a severe recession, similar to the Great Depression of the 1930s. In the first half of 2020, in 1 month, the unemployment rate in the US shot up to 15% in April, just at 44%. Right now, it is around 6 to 7%, and its decline has slowed down. But despite the development of the vaccine, the pandemic is not eradicated, and it may take a while for the economy to get back to its feet. In a typical recession, government and the Fed's policies help the economy to get out of the recession, but this time it is very different. I'm delighted to introduce today's speaker, Abby Cohn, Advisor Director and Senior Investment Strategist at Goldman Sachs in New York. She will be speaking today about navigating the economy and financial markets during the pandemic. Abby will talk about where we stand and the challenges the current administration is facing, and hopefully help us see clearer in this complex picture. Abby has quite an illustrious career. She is a member of the investment committee for the Goldman Sachs US retirement plans and the firm's liaison to the National Defense University of the US Department of Defense. Previously, Abby was chief US investment strategist and president of the Global Markets Institute. She joined Goldman Sachs in 1990 and was named partner just in 8 years in 98. She began her career, though earlier, as an economist at the Federal Reserve Board in Washington, D.C. And Abby has a very busy education and public service agenda. I was truly amazed at discovering all her activities. I don't know if her days are longer than 24 hours, but it seems to be. She's a presidential counselor at Cornell University. She's a life overseer of Weill Cornell Medicine and a member of the board executive committees of the Brookings Institutions and the Jewish Theological Seminary. She's a former board chair of the Chartered Financial Analysts Institute, which awarded her the Distinguished Service Award. Abby is an advisor to the investment committees of the Cornell University, the Metropolitan Opera, and other institutions. She previously served as vice chair of the board of the New York Economic Club and on the national board of the Smithsonian Institution. She's a member of the Council on Foreign Relations. And on top of all this, she's an adjunct professor at Columbia University and a guest lecturer at several graduate schools of businesses. And you might be interested in learning that she was also a member of the Obama White House appointed Innovation Advisory Board for Economic Competitiveness. Abby earned her degrees two degrees in economics, one from Cornell University and another from George Washington University. And she received 3 honorary doctorates, including one I just learned in engineering. She is recognized as a leader in US portfolio strategy and was previously ranked #1 by Institutional Investor and Greenwich Associates. Her career is the subject of a Harvard Business School case study, a Business Week cover story, and a profile in the New Yorker, which seems to have published a cartoon about her. I looked for it, I couldn't find it, to my disappointment.
We'll send you a copy.
Absolutely, I would be delighted. Abby, we are absolutely thrilled to have you. Before you start your analysis of the economy and the financial market, may I ask you a quick question on which might be of interest to students? How did your economic training help you in your career?
Well, before I answer that question, let me just say thanks to you, Professor Upton, for arranging this discussion today, and also to the Dean. There is a soft spot in my heart for Brooklyn College. The first member of my family who graduated from college graduated from Brooklyn College. And so I'm well aware of the importance of Brooklyn College and the entire city university system to the strength of our population and the strength of our city. Now, to answer your question, economic studies for me were absolutely essential to my success. People who are familiar with my career sometimes think of me as being a commentator on the stock market. And I've been fortunate, no one can be right all the time, but my track record is, shall we say, better than average. And I think that is directly attributable to my training in economics, because rather than looking only at the stock market, I always begin with the fundamentals of what's happening in the economy, what's happening in specific industries, and throw in a little math besides to make sure that things are priced in the markets the way they should be, based upon the foundation of what's happening in the economy, both growth, but also inflation and interest rates.
Thank you. It's very useful to know. Shall we start your talk now? Yes.
Absolutely.
Okay. Let me share the screen now.
So as we're putting the slides up, I should mention a couple of things. First of all, This presentation was done in large part by my research colleague by the name of Michael Wu, and I did see that Michael entered.
Yes, yes, know the name.
So I'm very pleased that he's here with us as well. And I should also say that the topics that I'm going to be discussing are actually only a few of those that are possible. That's why I'm so pleased that we'll have a fairly lengthy Q&A session following this. Can we maximize that screen? Would that be possible?
Sure. Oops, no, this is too much. This is too much.
Okay. I'll let you handle that aspect of it. So what I'm going to be discussing today has to do with the economy, where we are now, where we're likely to go on a short-term basis, by which I mean the next year or two. I'll also talk a little bit about the longer-term prospects. And then I was asked to spend some time on a couple of special topics, including what about this city? What are some of the prospects? And of course, to spend some time speaking about the financial markets. So without further ado, if we can move on to the next slide. And what you're seeing here, and I think we could probably, okay, if everyone is working off their screens, you could probably see that. So I guess we could just leave it as is. And what you see here is the busiest slide that I'm going to be using. So therefore the most difficult one to parse. And this is a breakdown of US gross domestic product, what's happening in the economy. We take it back to 2018 and we take it forward to 2023. And if you look at the column that's marked 2020 and then the one next to it, 2021, you'll see a fairly notable change. In 2020 overall, the US economy shrank by 3.5%. And while that may not sound like much, it's actually huge. It was one of the largest declines we have ever seen. We have to go back to the Great Depression of the 1930s. And of course, it was even more pronounced if we looked at it quarter by quarter, with the absolute collapse in the US economy in the second and third quarters of last year. And in 2021, we're expecting a notable rebound of about 7%. And an increase of that magnitude is also quite unusual. The arithmetic helps a little bit. If you're coming off a very low base, if you're coming out of a hole, it's easier to get a larger percentage gain. But you'll also see that in 2022, we think the increase, and these numbers come from our economics department, will be about 4.5%. And the long-term growth rate of the US economy is about 2.5 or 3. So to be at 4.5 is actually quite impressive. The growth this year, the bounce back, we think will be in any number of sectors, but I wanted to highlight just a handful. First, very interestingly, is the consumer. We think consumer spending, and that's the second line, will be up 7.7% this year, which is nice to see. As I'll discuss later, it's obviously a mixed bag. There are some consumers in much better condition than others. Some households have really suffered during the pandemic, others not so much. And I'll spend some time on that in a little bit. We also expect a fairly large increase of 17% in residential fixed investment. Residential fixed investment, for those who don't know, is economic speak for housing. Housing we see very robust. Some of it has to do with people deciding to establish new nests. Perhaps they've moved into new areas. Also, this is helped dramatically by the very low level of interest rates. So just the last line, industrial production, 15.5%. That's a measure of what is the economy actually producing. And you can see that after a decline of more than 9% in 2020, we see it bouncing back very substantially this year. Let's take a look at the next slide, please. And this one is a little bit easier to grasp because it's a picture. And it goes back several years. The blue shaded areas on this slide represent recession. And on the left-hand side, you'll see a recession that at the time we thought was very severe. It was called the Great Recession. And you can see that the various sectors of the economy really took it on the chin during that period of time. But take a look at the blue shaded area to the far right, and that is the pandemic. And obviously, far more substantial declines in the economy took place. What we've done here is broken out US GDP, the overall economy, into a variety of sectors. And different sectors have performed differently, but things like investment really collapsed. Business investment in equipment, spending in a whole host of categories really declined. There's only one line that moved up, and that's the sort of anemic looking line at the bottom. It's the grayish looking line, and that's government expenditures. So while the rest of the economy was really under incredible duress, government spending was picking up, and that, of course, was a policy decision. There was the pandemic package, the coronavirus relief package that was passed in 2020. And then as we go through the year, you can see that there was another dip in that spending. This chart does not yet reflect the last two tranches of coronavirus relief. And our belief is, and I'll discuss this a little bit more later, is that those packages, including the one that will be signed into law tomorrow of $1.9 trillion, will be very helpful in bolstering not just government spending, but also the support that will be provided to other sectors in the US. One important example is that there is relief provided in that package, not just to state and local governments, but also to the restaurant industry, which has been one of the hardest hit and has been the sector with the highest increase in the unemployment rate. Let's take a look at the next slide, please. This is unemployment. And again, the blue shaded areas represent recessions, and in recessions, unemployment, unfortunately, rises. And in the blue shaded area to the far right, that's the pandemic, it's almost hard to see because the rise in unemployment was so rapid. And that's what Professor Upton mentioned earlier, where over a very short period of time, the unemployment rate, the headline rate in the United States, went from about 4% to more than 15%. But it was worse than that because there are several unemployment measures. The one that we usually look at has the very exciting name of U3, but there's also U6. And U6 is more inclusive. It looks at people who are working part-time, who want more hours, but they can't find them. It also takes into consideration people who have left the labor force because they can't find work and they're so discouraged they're not even looking. Why is this important? Because the officially reported unemployment rate doesn't count those people as unemployed. I want you to think about that for a moment. When people are so discouraged that they're not looking for work, they remove themselves from the labor force, they don't get counted as unemployed. And that's why it's so important to look at that U6 number, which is still running about 10 to 12%. And so while the reported rate of headline unemployment has moved down to about 6, the true unemployment rate, and this is what Janet Yellen, the new Treasury Secretary, has referred to it as, is about double that. And that really is a problem. Let's move on to the next slide.
Sorry.
There are differences in unemployment by any number of metrics. And what we're looking at here is the difference by educational level. The line at the very bottom, that kind of dashed line, represents the unemployment rate for those people who have a bachelor's degree or higher. And their unemployment rate before the pandemic was something on the order of 2.5%. And their unemployment rate has moved notably lower from the pandemic high, but it's still just about 3%. So there has been good recovery there, but not complete. The real worry for the economy and for policymakers has to do with those people with lesser levels of education. And there we see, for example, that the line, which is the solid blue, representing people who don't have good education, that unemployment rate, and this is the U3 reported rate, is about 10%. The U6 number for these individuals with poor education, we believe to be somewhere between 20 and 25%. And this represents enormous economic pain. Let's move to the next one. Not surprisingly, families that have high educational level also have high household income levels. And these various sets of bar charts are moving along the spectrum of who has more education. At the left-hand side, we're looking at households where the head of that household doesn't have good education. And we see that for many of those households, the median level of annual income is something on the order of 25 to 30%. In some cases, earned income, salary, and wages are augmented notably by various forms of governmental assistance. And as we move further to the right, we see households with greater levels of education, and those that have college degrees or higher. What we see is that the median income level is something on the order of $110,000 a year, about 4 times what it is for those families that don't have good educational level. On the next slide, please, Professor Upton, what we're going to see is something that is finally getting enough attention. And that has to do with this inequality that has grown over the last several years. This chart goes back several years, and really this income distribution gap became dramatically more significant in the mid-1990s. So while the pandemic has worsened the situation, it was pretty bad before. I'll point out that this slide ends in 2017. So even before the pandemic, you can see that the people in the lowest quintile of income had seen very little improvement in their household income over the course of many years, but the people in the higher levels had done quite well. And we have to think about why that is. There are so many reasons. We don't really have time today to address them all, but think about education as being one factor that is at play here. In addition, we're also talking about a period of time in which the US economy was changing in terms of the nature of what we produce as a country. We went, for example, in the 1960s, from being a heavily manufacturing-oriented economy, advanced manufacturing, into one that has become increasingly a service economy. And very often when we think of the service economy, we think about white collar, we think about all of us who are so fortunate that we've been able to work at home remotely during the pandemic, but that's not the full extent of the service economy. The service economy is very much a barbell. There are those of us who are fortunate to be at the high end of the service economy, and then there are those at the low end of the service economy. Restaurant workers, people who work in hotels, people who have any number of jobs that I'm sure you're all thinking about, including the retail industry. And so all of this has contributed to this widening of the income distribution gap. Let's look at the next slide, please. Now, there's one other factor that Professor Upton asked me to address, and that had to do with cities during and after the pandemic. And something that has also been a distinguishing factor in job creation over the last 15 years or so has been where you live. And I want to be specific here. We've just talked about the role of education. We've talked about the role of some specific sectors, what industry you work in. But there's also been a huge difference between the economic success of cities versus that of less well developed areas, areas with less population density. And there are a couple of things going on in this particular slide. We're looking at job growth comparison by geography, and this is before and after what was referred to as the Great Recession, which was associated with the financial crisis of 2008, 2009. And before the financial crisis, we're looking at the light blue lines, and you can see that most of the job growth, the fastest increases, were occurring in suburbs and also in exurbs, that is the really far out suburbs. But something interesting has happened since 2010, and that is most of the job growth has occurred in our large cities in the United States. In fact, something like 3/4 or more of the job increases over the last period of time since 2010 have occurred in large cities, and almost all of the net increase in US GDP has occurred in large cities. And so the question about what will our cities look like after the pandemic is really essential, because the cities have been the major source, the major economic engine for our economy. Now, why is that? Many of you, of course, are committed to living in our fine city, and there are many things that you really enjoy about living in the city. You like the diversity. You may like the economic opportunity before and hopefully after the pandemic. There are also the ecosystems of universities and the companies that can hire and so on. So there's an awful lot that happens. There's also the cultural advantages. And, for some, when I say cultural advantages, that means the theater, or it means musical performances of various sorts. Cultural also means the presence of various people of different backgrounds, different ethnicities, different cultures, access to restaurants and so on. And so there have been many attractions to the large cities. And the question is, what's going on during the pandemic, and will it continue? I'll share with you some information about New York. Obviously, the constraints in New York have been far more stringent than they have been in other places. And as a consequence, our restaurants are not as open as other places. A week from Friday, they'll be going to 50% for the first time. But we also know that the large office towers in Manhattan currently have about 18 or 20% occupancy. And the concern there is, interestingly, the elevators. And so when you have a vertical city as opposed to a horizontal one, if people don't want to get into elevators because there are too many people in the elevators, that has been a constraint as well. Let's take a look at the next slide. A Harris poll was done not that long ago. And this is not New York specific. It has to do with cities in general. And the title to this slide, if we could just scroll down a bit, was "Cities Are Not Going Away." Now, this was the conclusion from the Harris poll people. And they asked people throughout the country, has your experience with the pandemic made you more likely to move to a different type of area? And let's scroll up a little bit again. And let's take a look at that set of 4 bars on the right-hand side. And the overwhelming answer is, I wouldn't change where I live. I wouldn't change where I live. And There are differences in the answers depending upon where people currently live. So people who live in central cities are basically saying more than 50%, I don't want to move. And the two categories who say that they're most likely not to want to move are the people who are already living in the suburbs. Okay, they're already there. So the question is, well, people living in other places, where are they likely to go to? And let's look all the way over at the left. These are the questions. I'm more likely to move to an urban area. And who wants to live in an urban area, likely to move to an urban area? People who are already in urban areas. And so what you see, at least based upon this Harris poll, is people are sort of committed to cities. People who live in cities like to live in cities. Now, I'm not saying this will apply to everyone. And there is, even in the Harris poll data, a difference between families with no children and families with school-age children. And families with school-age children are now showing that they're thinking about, if they haven't already done it, moving to the suburbs, and usually the close-in suburbs, because they do want proximity to the center city. And let's move on to the next one. Office space per worker in the United States. And what you can see is the amount of square footage allocated per worker is moving down. And you would say, well, yeah, of course, everybody who can is now teleworking and so on. I want to point out that these data only go through 2019. This does not include the pandemic. So the point is that there was already a trend in the United States to reduce the amount of square footage per worker. Why? Because more people were working remotely. Obviously, the percentage of people working remotely has picked up dramatically and will probably stay higher than it was before, but it's not going to stay where it is right now. According to the Labor Department, in the most recent survey they did, something like 23 or 24% of people are working totally from home. We don't expect that to stay at that number. In addition, as we've moved to a more digital sort of economy, we don't use printers as much, we don't have file cabinets as much, we don't have as much in the way of bookshelves, so we don't need as much space per worker. And also there are the questions about energy efficiency, et cetera, which has led many employers to reduce the amount of space they allocate per worker anyway. What does this trend mean for inner city office buildings? We'll see. I'm not an expert in this area, having spoken to people who are following these trends very carefully. They basically say the next year or so won't give us very much information. We need to think out further than that. And one of the reasons is this. This pandemic is not over, right? We're feeling so much better now than we did even a month ago because of the rollout of vaccines, for example, because the hospitalization rate is down and so on. And there is some reopening even in New York City, but this pandemic is not over. We are hopeful, based upon what we're seeing in the United States, that by summer and certainly by September, we'll begin to see schools reopening in a more normal way and so on. However, pandemic means worldwide epidemic. And with the exception of a handful of countries like Israel, the United Arab Emirates, the United States, which has a vaccination rate still in the mid-teens, is #1 in the world, where we have the highest vaccination rate in the developed world. Europe is lagging behind us, parts of Asia lagging behind us, places like Latin America, Africa, and so on are in single digits. So until there is a better vaccination rate around the world, the pandemic is not over. People will still need to be careful and so on. And so for the large cities, particularly gateway cities like New York that are so dependent upon international travel, this recovery is not going to take place over the next few weeks. It's going to be a protracted period. And let's move on to the next slide, please. So I spoke a little bit about the coronavirus relief packages, and I keep referring to them as relief packages. They haven't really been stimulus packages, right? They've been aimed at getting us out of the hole. And so when I think about what happens after the next year or two, we need to turn our attention back to the long-term commitments that our nation has typically made to our economy and to our population. Now, I showed you the data in the first slide saying that our economics team thinks that GDP growth this year will be about 7%, about 4.5% in 2022. But what we need to think about is what happens afterwards, not just in terms of GDP growth rates, but what happens to those people who were already left behind before the pandemic with regard to the industry they worked in, or with regard to their educational level or other opportunities they were being given or not given. Now, as an economy, we have led the world for more than a century in terms of our long-term investment in science, both basic science, research, applied research, and development. And for decades, there was really no comparing the amount of money we were spending versus other nations. This slide shows you that we're no longer alone. We are still above the pack, but the disparity is narrowing. The United States is that dark blue line at the top. That light blue line represents China. 10 years ago, Chinese expenditures on R&D were well below that of most other developed economies, but they have made a very conscious effort to really focus in on this because they believe that their future in the 21st century will depend upon this kind of heavy-duty investing. So the United States is spending. We're still #1 in terms of the dollars expended. But let's take a look at the next slide, which provides a much more sobering look. And this is how much are we spending on R&D relative to how much we could afford. That is R&D as a percentage of GDP. So we are scaling the R&D expenditure by how large our economy is. And we're not so distinctive anymore. For decades, we were #1, and #1 by a very significant margin. We aren't anymore. There are any number of countries that have, because it is their business model for growth in the 21st century, have been allocating huge sums of money relative to the size of their economies. Now, the data are somewhat idiosyncratic. I don't want to get into all of the technical details about why one country's numbers might be somewhat overstated or understated, but you'll see that there's a pattern. Israel and South Korea are the highest rated. Next, we see Switzerland, where almost all of that is related to pharmaceuticals. We then see countries like the Scandinavian nations, where as small countries, they have decided that they're going to invest heavily in education and heavily in R&D and so on. And the United States, our ranking keeps slipping, in part because these other countries are doing a much better job relative to their own history. And let's move forward, please. One significant area that I would describe as deterioration has been the commitment by our federal government to research over the last few decades. You'll see that peak that occurred in the 1960s. This was related to the Cold War. The United States was spooked, quite frankly, by the technological prowess of the former Soviet Union. We spent very heavily in the space race and so on. And what you can see is that as a percentage of GDP and as a percentage of total government spending, it has been declining ever since. And so our federal spending for R&D as a percentage of our economy used to be about 4 times what it is right now. Now, I want to step aside for a moment and say, well, wait, a lot of that spending in the 60s and 70s was related to the space race, and we don't have to worry about that anymore. That's not true in 2 different regards. Number one, so much of the basic research that gets funded by the federal government has many other applications. And I'm not going to give you the whole long list, but it includes the development of computers. It includes the development of the internet, obviously, satellite technology. Our phones wouldn't be as much fun or as important to us if not for GPS technology that was paid for and developed by the federal government. Even in the space race, one of my favorite fun facts is Velcro was developed by NASA because they didn't want to put metal on the spacesuits because it would heat up or get incredibly cold in outer space. So they needed Velcro. So all of these things that we take for granted in computer science, in satellite science, in material science, much of the basic research was paid for by the federal government. Often they funneled the money and the actual research was done at universities. Next slide, please. And by the way, if you're wondering where the one area where the Trump administration actually requested an increase in science spending over the last 2 years, it was in space science because they became increasingly concerned about how well many other countries, including the Chinese, were doing in terms of their own space programs. Now, one counter argument to this lessened priority by the federal government on spending on R&D is that corporations have picked up the slack. And they have, but only in some areas and not totally. So for example, business R&D activities in the United States are heavily skewed to only 3 industries: computer hardware, computer software, and pharmaceuticals. I don't see anything in there about manufacturing. I don't see anything there about non-computer hardware, or all of the things in which the United States used to be a leader, including the automobile industry. It's just not happening here. And one of the things to keep in mind is that corporations don't fund basic research, right? They can't afford to because there's a profit motive. They don't want to spend the money on basic research that may or may not pan out, either in the short term or the long term. A lot of basic research, as anybody who has scientific training will tell you, a lot of scientific research, you end up with a negative result. And companies don't want to be in the position of funding that and then explaining it to their shareholders. And so with the federal government kind of stepping away and corporations picking up the slack only in a small number of industries, it helps explain in part why the United States has lost primacy in some industries. I don't want to castigate the United States for doing really well in many different ways, but in some industries, other countries have really taken the lead. And let's move to the next slide. This I know is very hard to read, but it's a list of the top 20 companies around the world and who has the largest expenditures in R&D. And the United States is number 1 and 2 in terms of Amazon and Alphabet, which is the parent company for Google. But if you take a look, you see just how well companies in South Korea are doing in things like telecom and in semiconductors, and how well the German companies are doing in advanced manufacturing and so on down the line. And let's move to the next slide. The other thing to keep in mind, and I hope that the president will address it tonight when he speaks to the nation about the latest coronavirus relief package, is that this is not the end of what needs to be done. The administration is not yet ready to release it, but they are working on what happens next, right? not how do we get out of the pandemic, but how do we fix not just what ails us on a long-term basis, but how do we move ahead in a very positive, dramatic way? And I don't want to sound political, but I'll use the expression from the campaign, which was build back better. Well, how do you build back better? You're not just recreating what was there. You're trying to figure out what the new industries are going to be, and you want to make sure that you're prepared for it. And one area in which we have fallen somewhat flat as a nation has been not just in our investment in dollars in R&D, but our investment in people who are doing the science and technology research. Now, we still have a large number of scientists, and we're #1 in the world on that basis. But if we look at that and adjust it by the size of our labor force, we're not doing as well as we used to, right? So for example, in the 1950s and 60s, something like 30 to 35% of undergraduates on US college campuses were in the STEM fields. We didn't call it STEM then, right? We called it engineering or we called it math, but they were studying STEM. Right now, even with all the excitement over STEM, we're at less than half that on college campuses. So we need to do better, and we need to do better as well in the graduate level. So the United States really needs to enhance the sort of commitment we're making to education. And one of the things that we'll be hearing about, I believe, in the coming weeks and months, is that when we talk about the so-called next big bill from the administration on the economy, which will be so-called infrastructure, it's not just infrastructure like roads and bridges, right? It will be roads and bridges, not just building new ones, but fixing the old ones that aren't in good condition. Infrastructure would also be broadband for all of those people who don't have easy access. In our city, we know about the people who live in the inner city who don't have good broadband access and what a problem it's been for their children who are trying to do remote schooling. But in cities overall, broadband access is between 90 and 95%. In rural parts of the United States, it's only 60%, because the companies that provide broadband service couldn't make an investment case for them to do it themselves. So we think that that is part of the long-term investment in the country. And obviously a critical aspect of long-term investment is education, as we can see in this slide. And let's move on to the next one. Percentage of employees with doctorate degrees who are foreign born. Okay, now our city has a very large percentage of foreign born individuals. And so maybe it doesn't surprise you to see that in leading industries, including engineering and computer science, throughout the country, something like 60 to 70% of the people who work in those industries who have PhDs were born outside the United States. Only 17% of our total population is foreign born. So this is really, punching above the weight, right? So many of our foreign born residents are people who are very well educated. And just think how we would be looking in terms of scientists and researchers in the United States as a percentage of labor force if we didn't have these foreign-born individuals. So when you think about economic policy going forward and what's critical, I would suggest it's not just the things we've already discussed, it's also immigration. Because so much of the success of the United States, not just now, but since the founding of the nation and before, has been related to the fact that we have been a magnet to immigrants. And if we damage that on a permanent basis, there will be permanent implications for the US economy. Let's move to the next slide. Now, some of you have gotten to a more advanced study of economics, and you may know that economic growth in a nation is tied to a whole host of factors, but I'm going to simplify it into two categories. Long-term growth of an economy is related to the productivity of the workers. That is, how much does each worker produce, multiplied by how many workers there are. My apologies to all the faculty members for my oversimplification, but I think we all understand the message that the long-term growth of an economy is related to how well each worker is doing and how many workers there are. And so countries that have good growth in labor force do well. The dark blue line at the top of this slide, the country with the fastest labor force growth going back several decades, is the United States. And when we compare ourselves specifically to other developed economies, it is really extremely pronounced. The United States has benefited from good labor force growth, and over the last decade, something like 40% of that has been immigrants. If not for the flow of immigrants, and many of them well-educated, we would be in trouble. Michael Wu, who I mentioned before, who works with me at Goldman, did a very interesting study in which he showed that immigrants who come into the United States, often with poor education, poor language skills, and so on, by the time their kids hit the labor force, they are actually doing better than native-born Americans. There's something about the desire of immigrants to come here, to succeed, to work hard, that has been part of the magic potion that has enhanced the United States for so many generations. And I believe damage was done by all of the confusion over immigration policy in recent years. And we really need to settle that out and make sure that people from around the world know that they are indeed welcome here. And let's move on to the next slide. So here we are at markets. And this will be my last section of discussion. The light blue line represents the performance of the S&P 500, and below it you can see performance of any number of markets around the world. The United States has been the single best performing stock market in the world for many years now, and that has become quite pronounced during the pandemic, in part because there is confidence that the United States will be applying fiscal policy to give us relief. Number two, the Federal Reserve has been very active. And number three, many of our companies, our global companies, have performed extremely well during the pandemic. Next slide, please. That doesn't mean that there aren't questions to be raised. And one of the questions has to do with valuation. Simply stated, okay, let's say the fundamental picture of growth looking forward and profits looking forward is good. How is it priced? Are we already paying too much? And in the United States, the price to earnings ratio for the S&P 500 is now about 22 times earnings, which is pretty high. The only time we see the ratio get to those kinds of high numbers is when we have low inflation and low interest rates, as we have right now. In other countries, you can see that the PEs are in the mid-teens, which is also high for them, but also low inflation and low interest rates. And US companies are priced at a higher level than non-US companies. Let me give you two specific reasons. Number one, on this slide, on the rightmost column, you'll see return on equity, which is a very good measure of profitability. ROE in the United States is 50 to 100% higher than it is in other countries. So if a company is more profitable, you're going to want to pay a higher PE for it. And let's move to the next slide. The other thing that distinguishes the US, and I'm talking now about the S&P 500, has to do with the heavy weighting in our S&P of those three sectors where the R&D is being done. Computer technology, computer software, and also pharmaceuticals. And those stocks have been doing extraordinarily well. Information technology is 28% of the S&P 500, dramatically more than it is in any other marketplace around the world. And that helps explain in part why the S&P has performed so well. Next slide. I'm going to move past this one. So there's a question about interest rates. You know, one of the reasons we have a high PE is that inflation and interest rates are low. And we all know that interest rates are low. You know, they moved up a little bit in recent weeks, but they're still extremely low. And if you look at the right-hand side of this slide, you could see that interest rates most recently have been below even this long historical decline in interest rates. And I happen to love this slide. I don't know if you've noticed that it shows a long history. And not like most US economic slides that go back to 1948. This one goes back to the 14th century. We get these data mainly from information in Europe, but I think it's sort of fun to look at the fact that there has been, with the exception of periods of war in the 19th century and also in the 20th century, this downward decline in inflation and interest rates. And let's move to the next slide. Interest rates in the United States, as you know, are low. They've started to move up a little bit. Look how many countries have negative interest rates. While all of these developed countries, including Germany and other nations that have okay economies, have negative interest rates, it's kind of hard to argue that interest rates are going to move up notably anytime soon. We do think they'll start to move up, but not in a big way. We're talking about, you know, a 10-year treasury that, you know, is going to range about 1.5%. You know, in the 1980s, it was 18%. So we're really talking about low rates. And let's go to the next slide, which is the last one. When people talk about their worries about interest rates, they're saying, okay, the economy is starting to pick up steam on its own. And then we're going to get this fiscal policy stimulus, and the Fed is going to have to tighten interest rates, and it's going to be a problem. And in addition, there's an awful lot of debt. This chart shows you US federal debt as a percentage of GDP. And that's the right way to look at debt. It's not how many billions or trillions of dollars it is, but what is the size of that debt as a percentage of GDP. That dashed line on the right-hand side shows you where we are right now, including the pandemic. And I just want to show you that this too is a long-term historical perspective. It doesn't go back to the 14th century the way the interest rate chart does. It goes back to the founding of the nation. It goes back to when Alexander Hamilton was Secretary of the Treasury, and he cajoled the 13 colonies to get together by basically saying, if we all got together and incorporated as a United States of America, the federal government would take on all of the debts, the pre-existing debts of the colonies. And so we actually have a very good measure of what the debt load was of that early federal government in 1790. What we don't know is the size of the GDP, because most of the GDP at that time was agricultural in nature, and there's really not a good way to measure it. And a lot of it wasn't really traded, if you will, either externally or internally, right? A lot of it was barter, a lot of it was used locally, and there wasn't really a monetary attachment of value. But what you can see is that during periods of war, during the Civil War, debt as a percentage of GDP rose. 1860s, it rose very dramatically. World War I, and then of course the big increase during the Depression, World War II. But take a look at where we are now. Debt as a percentage of GDP is pretty much where it was in the Second World War. And that's a lot. And the question is it a problem? I would argue it is not a short-term problem. It's not a short-term problem because interest rates are low and the cost of paying the interest expense every year on that debt is currently not terribly burdensome. However, to me, what matters is what are you using the debt for? So for example, in 2017, a very large tax cut was passed in the United States. The estimate is that that increased the deficit by $1.5 trillion. And economists now estimate that there wasn't very much economic benefit as a consequence of it because of the way the tax cuts were targeted. It went to wealthy households that didn't spend the money, so it didn't go into economic stimulus. And a lot of it went to corporations who didn't use the money to do R&D investment, nor did they use the money to hire, to do the other things to grow their businesses. So a lot of that $1.5 trillion increase in the deficit is a consequence of the tax increases that were put into effect in 2018. It didn't really have much of a multiplier effect. Actually, it was not helpful at all. So what matters to me is what will money be used for? When we increase the debt now, what are we getting for it? And I'm asking these rhetorical questions because we don't know yet, right? We think that the $1.9 trillion in coronavirus relief will be helpful in terms of getting us out of the hole of the pandemic. Some of it will be helpful in addressing the problems for individual sectors that really got clobbered, including restaurants. There's a special piece in the package for restaurant workers. There's a special piece for state and local governments that were really hard hit during this period. There's some help for public transportation and so on, but we don't really know. We'll have to wait and see what the net benefit is for this spending. The other big question is this. If there is to be another big economic package proposed by the Biden administration, and whether you call it infrastructure or whether you break it into the various categories I mentioned before, which is infrastructure and education and scientific research and so on, to get us long-term growth, will it really be targeted for long-term growth? If it is, let's not think of it as a one-time increase in the deficit. Let's think of it as a long-term investment in the nation. And all of this remains to be seen. And with that, I'm going to stop. My apologies for going over my time, but I do believe we still have some time for Q&A.
Okay. Thank you so much, Abby. This was wonderful to have such an overview of the national economy, local economy, international economy. That was truly inspiring. Now, what I'm going to ask people is put their questions to the chat, as Dean Hu has explained. And I will start with previously sent questions. I have a number of questions that people have submitted last 2 days, and I'll start with these. So the first set of questions is from one of our associate professors, Mitch Langberg. The question is related to your last slide, debt to GDP ratio. Does this mean there will be an inflationary debt spiral? How does it affect the debt?
Yep. Great question. It's certainly the question that we're hearing from our investing clients and also from many others in the economics field about whether the current situation with the significant fiscal spending and with the Fed providing support, whether it's going to lead to inflation. And the answer is not yet. There are people who have been concerned about the inflationary consequences of our economy for an extended period of time, and they've been proven wrong. And so let me go back to the stimulus that was provided at the time of the financial crisis, 2008, 2009, the time of the Great Recession. And one of the arguments made at that time was that If we had a large fiscal response, it was going to be inflationary. And it simply was not. And much has to do with the pre-existing condition. If you're starting at a time when there is unemployment, that means there's spare capacity in the labor force. You don't get a big inflationary move. If there is spare capacity in factories and you provide a stimulus in the form of deficit or low interest rates, you don't get inflation. If you have a global picture, which we do right now, in which there is a lot of spare capacity, high unemployment rates, and lots of factories that are shuttered, and lots of businesses that are closed, it's hard to see where the inflation comes from. Now, that's not to say there won't be some, right? So even in our work, we're showing CPI going up this year, maybe to 2.5%. Part of it is because it was so low last year, right? So it's a rate on rate kind of change, number one. Number two, we are seeing that energy prices have moved up. We're not using as much energy as we did before, but energy prices move up and that has an impact on CPI. But we think that the underlying level of inflation is going to stay at about 2% over the next handful of years, even with the sort of stimulus that's being provided. Now, doesn't mean that your question is not warranted. And it's something that I believe everyone is going to have to be reviewing every 6 to 12 months as new data come in. But I'm going to make one other point that is often missed. The last time we had big inflation in the United States was in the 70s and early 80s. And there were things that were very different then. Number one, we had a tight labor market. Number two, we had an energy boycott that led to an incredibly sharp spike in energy prices. And number three, we had cost of living adjustments. Now, some of the people listening may not even know what a cost of living adjustment is, a COLA. Back in the 60s and 70s, the common thing was that for many contracts, including labor contracts with unions and the employers, there would be a cost of living adjustment. So if CPI was increasing by 3 or 4% without any additional discussion, wages would increase 3 or 4% or sometimes more than the CPI. And if you were a manufacturer and CPI went up 3 or 4%, you had pre-existing contracts with your suppliers and also your customers that your prices were going to go up 3 or 4%. And basically what happened is the whole economy was so indexed to inflation is that there were no braking mechanisms. No one was really sensitive to inflation rising because everybody was protected by these automatic adjustments. Nowadays, they don't exist. We have, for example, very few COLAs in union contracts, and something I didn't discuss but addresses part of the reason we're having the inequality problem is that labor unions have become much less powerful and they represent far fewer workers than ever before over the last century. But that I don't have time to discuss that, unfortunately. But if you don't have these automatic inflation adjustments built into the economy, it's hard to see where you get runaway inflation. Doesn't mean inflation won't rise, but it's at very low levels. And so maybe it moves to low levels, but I don't see it moving to high levels.
Thank you. Then I have one question that has come in various versions related to, I'm trying to combine several questions into one. Whether there is a sign that there is a bubble in the economy, and in that you can add the GameStop craze in your discussion, because that seems to be in people's mind, and whether also any chance of currency crisis.
Okay,
right?
So bubble in the economy, no, far from it. But let's talk about financial markets. In the stock market, our portfolio strategy team believes that stock prices in the United States, on average, using the indices, can rise from current levels. We've already seen the lion's share of the increase, but there can be more. Now, why is that? Because the expectation is that the economy will continue to grow, maybe in an erratic fashion, but it will grow. Corporate profits among the traded companies will continue to grow. Keep in mind that one of the bifurcations over the last year of pandemic has been that large companies have done okay and small companies have been really hurt. And what gets traded in the stock market? It's the public companies, right? And when I said small company, I'm talking about mom and pop and employers of small numbers of peoples, but a small company in the stock market can have revenues of $500 million. So when we're talking about really small companies, there's been this bifurcation, so the expectation that I have is there'll be a rotation in the stock market, right? We have seen technology stocks and pharmaceutical stocks perform very well. I think that as the economy shows signs of ongoing recovery and then ultimately expansion, those things are different, right? Recovery is getting out of the hole, expansion is getting beyond where you were. Then I think you start to see different sectors performing better. And that's important because when we look at the valuation of stocks right now, yeah, those PEs are very high for technology stocks, right? They're very high for some of the specialty stocks in pharmaceutical and so on. They're not so high among cyclical names. They're not so high among manufacturers. And so we see that there's room for movement there. Now, that doesn't mean we're complacent, right? This is a market that has demonstrated volatility. It can continue to demonstrate volatility and sensitivity to changes in policy, to concern, as was raised in the preceding question, maybe inflation does go up more than we're expecting. So these are the sorts of things that are worrisome. Now, there was a question about GameStop. I don't know anything more than is public about GameStop. And so I'd make the following observations. If stocks are trading on the basis of something other than their fundamentals, you need to be nervous. And so, that is worrisome. So everybody talks about GameStop, but as part of that whole process, there were also some stocks of companies that were bankrupt that were going up notably. So, if there's a touting of a stock and it's not based upon the fundamentals of the underlying company, I would be nervous about it. I also would use this opportunity to speak to the students for a moment. I know that there's a lot of excitement about websites like Robinhood and others, and of course, many other brokerage firms that don't charge commissions. And you may think that therefore your trade is free. I want you to think, however, about the business model of so many of these companies. And again, it includes many of the brokerage firms that you've heard about. How are they making money if they're not trading, if they're not charging you for a trade? The answer is that they hold back a little bit the way NASDAQ stocks always were traded. And that is they are making a small margin on what it is they're selling you, right? If you want to buy a stock, they go into the market, they buy it at a certain price, and then they mark it up and then sell it to you. So there may not be a transparent commission, but you're paying a fee, right? So when somebody says it's commission free, that's one thing, but you should always be aware that these companies are making money some way or other.
And the Bitcoin, your views on assessment of Bitcoin?
Yeah, I would basically parrot things that Janet Yellen has said about this. One of the things that's going on right now is that several of the central banks are trying to come up with their own digital currencies because there's nothing inherently good or bad about a digital currency. in that regard. However, there are concerns about anything that gets traded on the basis of something other than fundamentals, and that includes Bitcoin. There are concerns that have been raised about the energy consumption of digital currencies, including Bitcoin. You know, when you mine a Bitcoin, it uses an awful lot of energy. So I don't think we've seen the end of the story. I think that central banks, under the leadership of Jay Powell, and now with the involvement of the new Secretary of the Treasury, I think we're going to start to see more regulation, and perhaps a change in perspective of things like Bitcoin. And I'll just leave it there. Do we believe in the underlying technology, that it can be used for other things? Obviously, there's lots of benefit to those sorts of inventory systems and so on, but we'll see what happens. And by the way, I'm referring to blockchain specifically as opposed to a currency.
Okay, I think you already responded to several of these questions. Yes, there's one question about the situation, the household indebtedness situation, concerning the fact that half of Americans missed rent or mortgage payments due to COVID at least once.
Yep.
And these are mainly concentrated on 18 to 24-year-olds.
Yep.
And how do you think that this will affect the recovery?
Yep.
Yeah.
So let me start with the top down, if I may. When we look at the aggregate data in the economy, it tells us one story that is not complete, right? It basically says that savings, personal savings, have gone up during the pandemic. It tells us that monthly debt payments as a percentage of income have gone down, which tells you that debt is more affordable on average. The problem is that that's the average, right? So you have some families, mainly upper middle income and above, that are doing okay in this environment on average. But the real pain is obviously among those families that have lost work, and others that are having a problem. And we basically have been concerned about what I would call the foreclosure cliff in the United States. And I believe that the bill to be signed tomorrow will help not obviate it, but will help mitigate some of those concerns, because of where the relief will be provided. It will be targeted towards those families that really need it. In the first round of coronavirus relief, checks went out to lots of families that didn't really need the money. Everybody wants the money, but not everybody was in the same sort of dire straits. This time around, it will be targeted, as will the unemployment benefits, and so on. So we are concerned about this foreclosure cliff. We're concerned about the rent issue. And by the way, the foreclosure cliff is something that affects commercial property, not just residential property. Even in Manhattan, where the occupancy, as I mentioned before, of the big towers is actually quite low, companies are paying their rent, right? These companies are still doing okay. They're paying their rent. They may decide to downsize, but they're paying the rent. They have contractual obligations to do so. Where there is a problem is in the retail sector. Restaurants that can't afford to pay their rent, small retail stores that can't afford to pay their rent. And it's not just New York City, it's throughout the country. The non-payment of rent for retail establishments was something like 40 to 45% over the last few months. So it's a big problem. Now, just back to the rental situation in New York for one moment. The thing that I think is not well understood by many is that many of the landlords, to use that expression, in New York are actually small businesses themselves. Sometimes it is a small business that may own 8 to 24 residential units. And very often they don't have the financial pockets themselves to deal with the lack of rent payment. So I think this is one of the reasons that New York is going to have, in some cases, more problem than some other cities in digging out of the pandemic hole. In lots of other cities, the rental properties are owned by large corporations. In New York, a large percentage are not, number one. And number two, the unemployment rate in New York is much higher than it is elsewhere. I should have mentioned that before. The unemployment rate nationwide running between 6 and 7%. Here it's 15 to 16%. And part of that has to do with how many people we have working in the service sector and the areas that just got pummeled. And I've already mentioned them in terms of all of those who deal with travel and hotel and restaurants. New York normally has 60 million visitors every year. 60 million visitors, which means that everybody who had jobs in airports, in restaurants, even on those double-decker buses that tourists seem to like, these people are really hurting. So it's going to take a while until travel to our city resumes it's to any significant degree, let alone 60 million. And that's going to be a problem. Add on to that the problem with the rental situation. So I think it's going to take our city, some time to recover. And I am happy to see that the large companies in the city are beginning to move forward and putting forward suggestions and programs that might be helpful.
So related to this, what do you think about the real estate sector in the city or Manhattan and Brooklyn? And the question is the growth of real estate in getaway states going to continue, or the recent trends will reverse?
Yeah, I'm so glad you asked that question. And what Professor Uttam knows is that she and I are both on the Board of Economic Advisors to the New York State Legislature. And I have been banging the table politely on this topic now for several years. Because the argument among politicians is often, well, just raise income taxes on wealthy people and that will take care of everything else. And I have been showing the outward migration data from New York, in which people who can move, want to move, have been going to lower tax states. And this was happening before the pandemic. So what do we know about what's happened more recently, and what do we think will happen going forward? Well, during the pandemic, we do know that quite a few people moved outside the city. The good news is that most of them moved close by, right? So the people who moved to their second homes, if they were fortunate enough to have second homes in lovely places, we're not too concerned about that because it looks like they're maintaining their primary residences within the 5 boroughs. We are, however, likely to lose some people, particularly younger families, who have moved to close in New Jersey and Connecticut and maybe to Westchester County because they felt it would be a safer place during the pandemic and maybe the attraction of schools. The really interesting question for me are the extremely wealthy people, the top 1%, who have vacated and have gone places like Florida, Tennessee, and a whole host of others. You might say, well, what do they have in common? They have no state income tax, and some of them have no estate tax. I don't know what's going to happen, although there was this great article published just today by Bloomberg News, and they quoted one of these people who has moved from New York to Florida and is now moving back, saying, the problem with moving to Florida is you have to live in Florida. So as somebody who is committed to New York, I'm speaking to you from my apartment in the 5 boroughs, I was sort of amused by that. And so We don't really know. There are many firms, particularly in financial services, that have the wherewithal, the flexibility to do their business wherever. And some of them may do that. I think the more likely trend to watch for is that when we, quote, return to the office in New York, it won't be 100%. I think many people will say, you know, I really would like to work from home 1 or 2 days a week. And pre-pandemic, you know, sometimes that wasn't viewed as cool. Sometimes that wasn't viewed as like really being with the program. I think managers will be pretty happy with people working from home a day or two per week, because that's what they'd like to do as well. People have gotten accustomed to that kind of time flexibility.
Okay, so we're having more and more questions, but I'll just take a couple of more. So this is a more specific question. On the growth chart that you have, this is from a Professor Cohn. Equipment is high, 15% in 2021. Is this technology both standalone and embedded?
Yep.
Very specific question.
That is a terrific question. The answer is all of the above. We continue to see heavy investing in technology. You know, clearly, you know, we all discovered that we needed more equipment at home than we had pre-pandemic. So part of it is that, number one. Number two, we are seeing some, the opposite of outsourcing. We're seeing insourcing to the United States because of supply chain disruptions during 2020 and in early 2021. Many large US companies are saying, you know what, they're bringing some of the stuff back to the United States. And so that's good news for the US. It's also, by the way, good news for Mexico and Canada, because some of the stuff that had been outsourced to Asia, for example, is coming back to North America. So that's good news for our close neighbors here. So that's all part of it. And I think that also that large percentage gain sometimes represents, again, the fact that we were in a hole, and that there are companies saying, you know what, it's time to re-up, it's time to fill in some of the gaps. And so we're seeing it really across the board.
Yeah, so one from a PhD student, actually. It is, how is the aging workforce going to be a factor in the economy, specifically when it comes to growth rates and long-term debt obligations? Or is immigration large enough to minimize this problem?
Yeah, fantastic question. And this is probably a great place for us to end. You may recall that my last slide showed that mountain of debt that was going to get larger and larger over the next 2 to 3 decades. That is the aging of the baby boomers.
Okay, that was another question.
Yeah, so it's the aging of the baby boomers. You know, I take responsibility. You know, I'm right in the middle of that pack. Basically, for many years, the baby boomers were the single largest population cohort in the United States. This is the group that was born after the Second World War up until, some people say 1957, some people say 1964, whatever. But this is a group that when it retires, couple of things will be happening. Number one, yes, drawing Social Security and taking advantage of Medicare, but also not paying as much in taxes. And this has been a very high earning group. And so that combination is not terribly helpful. So that's one aspect. The other thing we don't know is what impact the pandemic will have on the baby boomers. Will some of them decide that, you know, they were working throughout the pandemic and, you know what, enough is enough, time to retire? Or will some who were in different economic circumstances say, I now have to work longer? We just don't know what that balance is going to be. And obviously over the next couple of years, we will learn more. One quick comment, by the way, the expansion of Obamacare is something that will dramatically reduce the long-term forecast for Medicare expenditure. Now you may say, well, what is the connection? One of the reasons Medicare was so expensive is that many people had lost their insurance coverage. And the most expensive year, listen to this, the most expensive year for Medicare is, unfortunately, of course, the year a person dies. The second most expensive year is not the year before that. The second most expensive year for Medicare is the first year somebody's on Medicare. Why? Because with so many people having lost their private health insurance before Obamacare, people were delaying their healthcare coverage, right? So they were waiting until they were on Medicare the first year, and they were taking care of longstanding chronic issues, running from asthma to cardiac problems. They were doing joint replacements. Anything that could have been postponed, they postponed. And so that second year, that first year of Medicare enrollment was very expensive. That has dissipated notably. So it may very well be that those projections for Medicare expenditures will calm down. So that's my answer on the aging of the baby boomers. And Mary, remind us all what the first part of the professor's question was.
No, that was it. That was the, when it comes to growth rates and long-term debt obligations.
Okay, so growth
Or
rates.
is immigration enough to that?
Exactly. So that was where I wanted to end, and that is the growth rates. When people leave the workforce, what matters is there somebody there to replace them? And I believe that that's why immigration is critical. The natural birth rate in the United States is not terribly impressive. And what we have seen during the pandemic is it went down. I have hopes that it will pop back up over the next couple of years. But we also know that the birth rate is higher among immigrant communities. So not only are the immigrants themselves coming in, their families have a higher birth rate. And as I mentioned before, second generation immigrants perform very well educationally and economically. So the lifeblood of this country has got to be immigrants coming in. And this is particularly important now as the baby boomers start to retire and leave the workforce.
This was wonderful. Thank you so much, Abby, for having instructed us on so many topics. Really appreciate it.
My pleasure, and my thanks as well to the Dean. I'm delighted that you're doing this speaker series. It was fun to be the first, and I just wish you and all the students and the faculty good luck as the program proceeds.
Thank you.
Thank you so much, Abby. It is just a wonderful lecture. I'm sure everybody learned a lot. Even I am not an economist, but I feel I have learned quite a bit about economy and everything. So it's so wonderful to have you as our inaugural speaker for the Dean's Leadership Speaker Series. We're so thankful for your insight. And I want to thank everybody who participated. They raised many questions. I know we cannot answer all of your questions because of time, but I hope to post the entire video as soon as possible on our Koppelman School website. So once that video is available, I will send a link to everybody who registered to your registered email so you can view and share this wonderful lecture. Thank you so much, and I wish everybody have a wonderful day and a great weekend and a great future.
Thank you.
Bye, everyone.
Bye-bye. Thank you. Thank you, Abby, so much. Thank you.